Following pre-recorded program is sponsored by Adams Financial Concepts. Welcome to About Money, a different approach to investing you won't hear anywhere else. Your host, Mike Adams, is a registered investment advisor and works with investment portfolios exceeding over $100,000 in net worth and has a proven track record of managing long-term investments, surpassing the markets in the long term. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's Mike.
And it is Saturday, and we're talking about money. You know, when my returns came in for last year, and I was up 77% for last year in the growth accounts, up about 200% in the profit sharing accounts, and that followed a 40% return in 2019. I had to sit down. The numbers seemed almost unreal. And so I sat down, and the profit sharing accounts, those have been going only since the 1st of April, and so I didn't really look very much at them, but I wondered, okay, 40% in 2019 and 77% in 2020. You know, if I'd seen someone else publish those numbers, I would have huge doubts. So I began to look at what went on. What was it? Was it just luck, being at the right place at the right time? Or is there something more about it? You know, my philosophy has been for the time since I've started Adams Financial Concepts to look at things in a forward-looking sense. While you have a lot of people who are using algorithms and using historical data, and they're massaging algorithms, they're massaging all the data. I mean, some of the huge computer programs that massage so much data that a human can't even get their hand around. It's enormous what they do, but they're all looking backward. My focus has been to look forward, to look at what's coming and what's changing. I use the quote from Sagan to say, things that have never happened before happen all the time. I want to be prepared for those things, and I want to see some that are coming. And sometimes it works and sometimes it doesn't work. But that's been my focus. It's not a historical look. It's actually looking forward. It's realizing that history doesn't repeat, but that it rhymes. There's some things you can pick up from history, but to depend upon the data from history, we live in a dynamic world. And it's not as if we can go back and determine this is how things are going to play out forward. If you talk about the speed of light, that never changes. It didn't change from 100 years ago or 1,000 years ago. Those changes are fixed. It's the law. Gravity has not changed. Those things are physical and obey physical laws. But the economy and investing, we live in a dynamic time. And so for me, it's looking forward. It's looking at changes in technology, changes in lifestyles, and changes in demographics. So with all that in mind, I started looking at things, you know, and thinking about the pandemic, about the Great Recession. Those were things that had never happened before, and they happen all the time. And I started thinking about one of the programs that I did in the past, an example of where it's a matter of looking forward instead of backwards. And that was the program that talked about British Petroleum and Exxon. Both companies prepare forward-looking outlooks. They look forward anywhere, usually around 20 years, but because we were in 2020, BP was looking forward 30 years to 2050. Exxon continued 20 years out to 2040. And what BP said was that we are at peak oil right now. We are seeing the peak demand for oil. And what's going to happen is that oil is going to begin to decline. Now you have to remember that the number one industry in the world with tremendous political power, with tremendous financial power, with the ability to make changes in countries, they can almost make changes in government, is the oil industry. And they're very powerful. But what British Petroleum said is we're going to see a decline in the use of oil. They said that global energy demand is going to continue to grow, and it's going to be driven by the emerging nations. We're going to continue to grow our energy needs. We're growing electrical demand by about 1% a year. We're using it more and more efficiently. But in those emerging nations, those nations where 93% of the world's middle class will live by the year 2030 or 2032, somewhere in that range, 10 years from now, that is going to continue to create energy demand. But while energy demand is going to continue to grow, fossil fuels are going to decline as renewable energy grows. And there'll be a transition to lower carbon energy with greater consumer choice and a restructuring of the energy system, a complete restructuring. Oil demand is going to decrease for the next 30 years as a function of the increasing, the increasing efficiency and electrification of road transportation. The biggest consumer of oil are cars. And we're seeing already the announcements from General Motors and VW and Ford. They're moving to electric vehicles. That's going to reduce the demand for oil. And natural gas will be more resilient than oil in supporting fast-growing economies in the emerging countries. But that's the reduction in coal is going to continue. There has been a reduction. It's going to continue. And natural gas will continue to grow. However, natural gas, and this is an aside to the British Petroleum Report, natural gas, as we've reported before, natural gas produces methane. While carbon dioxide remains in the atmosphere until it's either removed or stays there forever, methane stays there for 20 years. And it's far more potent than carbon dioxide. But we're going to see more methane roll into the atmosphere for a while. But it, too, will become a reduced source. There's going to be a lot of new technologies. They're going to look for energy storage, and we're seeing new battery companies arrive. We're seeing new technology arrive for batteries. That's all going to happen, and all of that with solar and wind power and hydrogen are going to increase the energy system without carbonizing the atmosphere. In fact, we'll see energy systems that actually decarbonize, and we'll see a mix of blue and green hydrogen. Biofuels will come into play. That's what BP had to say. That was their outlook. That was where they saw things going. Exxon, on the other hand, came out and said, we feel just the opposite. Now, they didn't say that we feel the opposite. What they said is our outlook for oil as energy is also going to increase. We see that continuing. But we also see that oil is going to furnish 50% of energy demand by the year 2040. They see that over the next 20 to 30 years, oil supplies are going to increase, and there's going to be a greater demand for the use of oil. Two opposite sides of the outlook. Now, in 2016, both Exxon put out their energy outlook, and OPEC came out. And Exxon at that time said, we are not concerned with electrification of automobiles because our forecast is by the year 2040, fewer than 1% of all the cars sold, and we expect a billion cars to be sold in 2040, fewer than 1% will be electric. Well, that was just 4 or 5 years ago, and now we know what's happened. General Motors has announced they're going to be all electric by 2035. Ford announced they're going to be all electric. VW says they're going to move all electric. When you look at the companies, they're talking about moving toward electrical vehicles. It's not easy when you look There was an article published not too long ago talking about the issues faced by Volkswagen in converting to electric vehicles. Right now they get their software from 114 different software vendors. 114. Think about that compared to Tesla. Tesla has one. It's all internal. Developing that whole system in an electric vehicle is not something where you just take the internal combustion out and stick in an electric motor. No, you've got all the software that has to go on. So that's why GM says it's going to be 2035. There's 13 more years before they're going to be ready for that. Ford is taking a decade. VW is taking a decade. All of that going forward. So those are two competing views. You have to look forward and decide, where are we really headed when you're looking at building a portfolio of stock? This is just one example, but we'll come back to this after this commercial break. We are coming to a commercial break. So don't go away. I want to continue this thought. How did I get 77% and 40%? Actually, 200% in the profit sharing accounts. Stay with me. We'll come back to that question right after the commercial break. And if you missed this program or some of the others, you can find us on YouTube. You can find us on our website. So stay with me.
About Money with Mike Adams on AM 1590, The Answer. For more information, click on Adams Financial Concepts. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
So I started by talking about the program and my results. If you look back in 2020, the composite of my client accounts, my client equity accounts, the stock accounts, the composite were up we're up 77% in 2020. They were up 40% in 2019, and we're off to a good start in 2021. It's been quite a year all the way through. So what is it? Why is it? I spent some time. I spent a lot of the time in the month of January, because when I looked at those numbers, they seemed astounding to me. And while I know that past performance is no guarantee of future results, I knew that I had to know whether it's luck, whether it just happened to be in the right place at the right time, or whether there was more to it. And I started to explain that in the first segment when I said, my approach is very different from most. Instead of looking at historical data, if you take a financial plan, for example, they're looking backwards. They're looking at the average return in stocks, the average return in bonds, the average return in commodities, the average inflation rate, looking backwards at what has gone on instead of looking forward. And my approach has been to look at things going forward, look at changes in technology, changes in demographics, changes in lifestyles, trying to determine what's going to be happening. Because, and I use that quote again and again and again, you'll get tired of it, things that have never happened before happen all the time. And so that's my plan going forward, is to anticipate that. So let me come back to where I am. When I've been building portfolios, and I've been doing portfolios for 35 years now, and during that time, I've focused on trying to find those stocks which can deliver very, very high results. Peter Lynch called them 10 baggers. Some people have called them home runs. Some people have called them the long tail, because when you look at that bell-shaped curve, way out at the far right-hand end is what's called either the right hand or the left-hand side is called the tail. And that tail, I'm looking for things way out, the outliers, the stocks that are going to be outliers. That's what I've been seeking. And if you could look back in history at my portfolios, you'll find that during the years, I always had one or two of those 10 baggers. There were always one or two. And yet, looking back at what began to happen in 2019 and 2020, when I look back, I had one 10-bagger that was just kind of trailing off, but I had another one that I picked in 2016 that was really beginning to pick up. And in 2019, I picked up three more. So one was trailing off, one was picking up, and now I had three that were rolling. So if I look at the end of 2020, what was going on, four of the stocks in client portfolios were 10 baggers and were increasing at a significantly higher rate than average. 4 out of the 10. Most portfolios are running 8 to 10 stocks. So looking at 10, 40% are doing well. There's an impact that a concentrated portfolio. If you have a portfolio which has 30 stocks and you have one that was a huge winner, it probably doesn't really make a blip at all. But if you have 4 stocks, 40% of your portfolios where you've got a big win, it makes a huge difference in the portfolio. So that's where I was in 2020. We had 4 big winners, and as we look at 2021, there's 2 or 3 more of the stocks that I picked. Now, I don't always pick winners. Sometimes I pick losers. There was a study that was done by J.P. Morgan back in 2014, and they looked at the stocks in the Standard & Poor's 500. And stocks are moved out of the Standard & Poor's 500, and stocks are moved in. And they looked at the ones which had been taken out by acquisition, somebody had acquired them, or stocks that had moved, that had somehow, other than just being losers, had been removed from the Standard & Poor's. Merged, acquired, they took those out of the group. But they found, of the 500 stocks, 320 had been removed because they were losers. Because they were losers. Think about that. Of 500 stocks in the Standard & Poor's 500, 320 came out because they were losers. 70% practically were losers. So when you think about it, 30% of the stocks are driving the Standard & Poor's index. That's why, one of the reasons why I can beat the Standard & Poor's index, or that's my track record, knowing that past performance is no guarantee of future results, and I always have to say that. That means that 30% are winners, and 70% are losers, and yes, I picked some of those losers. They've been in my portfolios. But what that means is, in the past, before 2019, 2020, in the past, when I had 1 or 2 10-baggers, there might be 1 or 2 or 3 losers. And so my 10-baggers, my big surging stocks, had to more than offset the losers. They had to deliver excellent results, plus cover the loss of stocks. And yes, in 2020, I had a loser, and I did cut it loose and replaced it with a stock, in fact, that looks like it's going to be a significant winner, at least. That's the early indication, and it's still very early. So that's what happened. Instead of having 1 or 2 10-baggers, 1 or 2 home runs, in 2019, it started to accelerate. In 2020, 4 really kicked in. All the stocks, all 4 of those stocks were in the portfolio in 2019. All 4 of those stocks were starting to roll, but some were added in 2019, and so they only got a partial year. Had they been in the portfolio all year long, it might have been much better than a 40% return in 2019. So what does that mean going forward? I'm guardedly optimistic that we will continue to see strong results. That's my outlook. I'm optimistic for 2021. I'm optimistic for 2022. I'm optimistic for 2023. I think that these stocks that are in the portfolio have significant momentum, and they have not momentum in terms of stock price, but momentum in terms of revenues and earnings, and that's what I look at in terms of momentum. I'm not so concerned with stock prices going up or down. I'm concerned with revenues and earnings and controlling the debt. That's what I'm looking for. That's where I see things going. And that's what I analyze my results, looking at whether it's luck or whether it's skill. And I've always believed that it's skill in the long run, luck in the short term. But in 2019, 2020, I believe it was more skill than luck. Maybe it was lucky picking the right stocks. Who knows? That's where that is. There was something that I came across, and I want to shift subjects for a minute and talk about this. An article I came across, I talked about it once before, but I want to talk about it again. It came out of a book called yes, and I missed my notes. So I'll get back to it in a second. But this is the idea. Consider an investment of $100,000. And the person who's proposing the investment asks you to take 100% of the risk. But if the investment makes money, the advisor and the firm get to keep 60% or more of the profits. If it loses money, you take 100% of the loss. Plus, you have to pay fees of 10% or more. Does that seem like a really great deal for you? $100,000 investment, you take 100% of the risk. If you do make money, they get 60% of the profits, and you pay 10% of fees. Would you take that investment? But that's precisely what happens with mutual funds. And the book, I found my notes. It's The Money Master the Game by Tony Robbins. That's what he's talking about. That kind of investment. When you're investing in a mutual fund, you're taking 100% of the risk. And if you make money, 60% of the profits roughly are going to go to the firm and the advisor, and you're going to pay 10% of the returns and fees. That's looking at the average return. Do you think that's a good investment? Do you really think that's a good investment? I think that doing the profit sharing account or doing the growth account is much, much better. I think the returns of 40 and 77% were maybe on the high side, but I think that we're going to continue to, I'm guardedly optimistic about the returns going forward. And I know that past performance is no guarantee of future results. But you have it, you can see it. I post those results on my website. I'm one of the very few advisors that post client returns on the website. And they can be verified. So don't go away. I want to come back to some of this after the commercial break. So stay with me. I want to talk about active and passive mutual funds and managers.
About Money with Mike Adams on AM 1590, The Answer. For more information, click on Adams Financial Concepts. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
So as long as we're talking about mutual funds, let me talk about managers of mutual funds. Active versus passive mutual funds. You've heard the things said about passive mutual funds are outperforming active, and active mutual funds are actually seeing outflows compared to passive mutual funds, investing in the Standard & Poor's. I'll take you back to that study that was done by J.P. Morgan that said in the Standard & Poor's, 320 of the 500 stocks were bounced out of the Standard & Poor's because they were losers. 320 out of 500. 70% were bounced out of the Standard & Poor's. 70%. I got to repeat that figure. 70% are losers in the Standard & Poor's 500. That's an incredible number to me. And what that means is it's driven by a relatively few stocks, 30% of the stocks. You know, that's 180 of the 500 stocks that are driving the returns. And in the most recent years, of course, it's been 5 or 6 stocks, the FANG stocks, that have driven a good portion of the return, 20 to 30% of the return. And by the way, I don't own any of the FANG stocks. They don't meet my criteria. You will not find them in my client portfolios. You'll find one of the FANG stocks in one client portfolio that came in with a client, and the client doesn't really want to move out of that stock yet. She will one day. But that's no FANG stocks in my portfolios. Everything is beyond the FANG stocks. But it's a limited number of stocks in a passive portfolio. You're taking a lot of winners and losers. So what has been the result? Eugene Fama did a study and found that only 7% of professional money managers, including the mutual funds, actually do as well as their benchmark. If your benchmark is the Standard & Poor's 500 total return, only 7% of professional money managers get a return that's enough to cover the fees that are being charged. And only about 3% to 5% are actually earning more than 1% a year. I stand in those. You look at my returns, since I've had Adams Financial Concepts, we're sitting at significantly above a 1%. Very much above 1%. But, so what's going on with mutual fund managers? Why? So Porter and Triffs did a study called The Career Paths of Mutual Fund Managers, the Role of Management. And they wanted to know what went into and what was the relationship with performance. So there's been a lot of literature on the performance of mutual funds, but not much on the managers. So they focused on the managers, and they looked at the length of a time a mutual fund was managed, or the length of time a manager managed a mutual fund is what I'm trying to say, the length of time they served as a sole manager. And they found that in the first year after a mutual fund was released to the public, in the first year, 18.8% of the fund managers were fired, relieved. In the second year, another 19.4% were gone. So if you look at the first 2 years, a third of mutual fund managers are gone because they can't perform. In the third year, it's 17%. So if you look at the first 3 years, half of mutual fund managers do not survive the first 3 years. There was a study done by Standard & Poor's. It comes out every year. They looked at it in 2019. They looked at the last 20 or 30 years for mutual fund performance and how they had done. And they found that about 40% of mutual fund managers managed to beat the market for the first 3 years of existence. And then in the fourth year, it drops to 10%. And over the next years, it drops to 5%. By the end of 10 years, only 5% of mutual fund managers actually do as well or better than the benchmark. But in the first 3 years, half of the money managers are gone, mutual fund managers. In the next 3 years, 4, 5, and 6, more than a quarter are gone. So if you look at the first 6 years, by the seventh year, 3/4 of the mutual fund managers are gone from managing mutual fund. 3/4. If you look at those that make it 10 years or more, it's just under 7%. Guess what? Fama found 7% of money managers earned their fees over 10 years. What Porter and Triss found was those numbers are eerily the same as what Fama and French found, and for what Fama shared the Nobel Prize in 2013. Numbers are extremely close, 6.85%, and Fama found 7%, and maybe it was rounded to 7%. So it's a function, actually, of the mutual fund managers. They're the ones that have the ability to do it. I usually say that investing is an art, it's not a science. If it was a science, the person with the biggest computer would always win. And we know from what we're seeing, hedge funds did not do well in 2020. The reason they didn't do well is because they rely on historical data. They crunch huge numbers of data with their huge computers. They plug all that information in, and they continue to plot it out, and they continue to look at the history, continue to look at what happened in the past, and they can build all sorts of algorithms to analyze it and put it down and backtest and backtest and backtest and come up with the best way to manage money based on past data, based on the past. And if everything remained constant, everything remained just like it was last year and the year before and the year before that and the decade before that and the century before that, if all of that remained constant, they would have a slam bang win. So things that never happened before happen all the time. What happened with hedge funds is that, or for a lot of hedge funds, there were some that did well, but a lot of hedge funds never knew there was going to be a pandemic. Actually, I didn't know there was going to be a pandemic either, but looking forward, you begin to see changes you need to make. And based on historical data, there was nothing in the historical data to prepare them and to make changes that needed to be changed in times of a pandemic. None. Zero. So what happened is they had poor results. And I'm not talking about just the GameStop thing. They had poor results before they ever got to GameStop. And GameStop, of course, gave a number of hedge funds a bigger headache. It was Return Stop instead of GameStop. But that's another whole story. I talked about that in the past. But if we look at what happened in 2020, hedge funds underperformed because they were looking at historical data. Think about that in another sense. Financial planning. Most financial advisors today are doing financial planning. What do you do with financial plans? You're looking at historical data, just like the hedge funds did. You're looking backwards, and you're trying to forecast the future from looking backwards. There's any number of back-tested models. Back-tested means you come up with your algorithm, you come up with your plan, and then you test it backwards. You say, I think we're going to do these kind of trades. Then you test backwards, and you go back 20 years or 50 years or 70 years or 100 years. You can go back to the 1920s, and you can go back and you can say that's from the 1920s to the 2020s. This is how it would have worked if we would have used my formula. Put it into a model. Does it work? And most back-tested models always look really good, because if they look bad, they're discarded anyway. So that's back-testing. But we live in a dynamic time. We live in a time that's changing. And so, looking forward, they don't do so well. That's what happened with the hedge funds. That's what happens with financial plans. Because they're backward-looking, because they're based on past data, they do not look toward the future. If there's one thing that separates Adams Financial Concepts from everyone else, or from most other people, is we're looking at the future not based on historical information, but based on where we see the future coming and where we see the changes in technology, lifestyles, and demographics. What's going to happen, and how is it going to happen? And what are the odds it's going to happen? And how can we be in front of it instead of trying to catch up? That's where we are and what we're trying to do. That's when I look at what happened in 2019, 2020, and the returns we got, it's because we were in front of what was going on rather than being behind. And yeah, 2020, some of the stocks were accelerated because of the pandemic, but they would have made it anyway. Coming to a commercial break, I want to finish off with another segment and talk about a different kind of study, a study that was done. Do bigger firms get bigger clients? Are small firms lost with small clients? We'll come back and we'll talk about that right after the commercial break. Stay with me. I want to hear what that has to say.
About Money with Mike Adams on AM 1590, The Answer. For more information, click on Adams Financial Concepts. About Money with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com.
I want to finish by talking about, do bigger firms attract wealthier clients? And I will come to that. I just had another thought as I was finishing, and during the commercial break, I had another thought. What does it look like going back? Jason Zweig, in a Wall Street Journal article back in 2014, interviewed Charlie Munger, and Charlie Munger is Warren Buffett's partner, and they talked about money managers. And Charlie related this story that said, and I quote, "Everyone wants to be an investment manager. Raise the maximum amount of money, trade like mad with one another, and then just scrape the fees off the top. I know one guy, he's extremely smart and a very capable investor. I asked him, what returns do you tell your very capable investors? Do you tell your institutional clients you're going to return for them? And he said 20%. Charlie Munger says, I couldn't believe it because he knows that's impossible. But he said, Charlie, if I gave them a lower number, they wouldn't give me any money to invest. That's very factual interview. You know, my returns of 40% and 77% were off the charts. I like that. But if I go back and I look historically what I've done, and I published those numbers since I started Adams Financial Concepts, my returns have been 13.14% versus the Standard & Poor's 9.75%. That's a 3.5% difference almost. And what that means is, had someone invested $100,000 with me 16 years ago, it would be worth $699,311 by the end of 2020. And if they'd invested it in the Standard & Poor's, it would have been $433,050, which means my advantage over that time, that difference between 13.14 and 9.75, was a difference of $266,000. Almost a third more investing with Adams Financial Concepts is investing with the Standard & Poor's, and the S&P 500 index would have produced a little less than that. And that is the total return. That's with dividends reinvested. And if you look at where I've been since the bottom in 2009, my returns are over 20%. Now, there's going to be times when it's going to be flatter, but the returns have been very good, and I'm very guardedly optimistic about going forward. No guarantees. Past performance is no guarantee of future results, but that's where I am. Now, I want to talk about some studies that have been done asking the question, are bigger firms attracting wealthier clients? And there was a couple articles that have been published, one by Bob Veres, some by a couple other authors. They looked at the fact that when you look at firms and you look at the average size of clients, you take the number of assets they have, you divide it by the number of clients, you find that bigger firms generally have accounts that are bigger size. The average account is bigger. And Various took it further. He said, if an advisory firm looking at their annual revenues compared to the average size of accounts, if annual revenues of account were under $1 million, and ours are above that, but if they were under $1 million, that they had somewhere between their average size account was under 500,000. They had between 41 and 28% of their accounts that fell in that category, and of accounts that were over $2 million, they had three to actually. I'm looking at the numbers. They had 5 to 7%. So those were small firms. The firms that had over $8 million in revenues, they had only 7% of accounts that were averaged less than 500,000, and they had almost 50% of their accounts above 2 million. And I looked at that, in relation to what's happening in the industry, because the average return for financial advisors is running around 4%. Now, while we're running at, since the drop in the market since 2009, we're running at 20%, and since going through the Great Recession and through the pandemic, all that period of time, we're running over almost 13.25% versus the Standard & Poor's 9%. So what we're seeing growing accounts significantly higher than are most financial advisors. Most financial advisors, most firms are acquiring new clients. That's their method of growth. Either that, or they're acquiring other firms. And there are now a number of firms in the financial services space that are doing roll-ups. And what that means is they're going in and they're buying out individual firms. They're buying out smaller firms, aggregating them. And when they do that, very often what they're doing is focusing on the larger clients and dumping the smaller clients. I can remember when I got into the business back in 1986, Merrill Lynch started that program off by setting up a call center. And if your account was less than $30,000, you went to a call center. Now they're at $250,000 for people that go into a call center. But that's happening in the RIA space as well. I listened to a seminar the other day in which the advice was, and it wasn't just that one seminar. I hear this repeated very often, that most of your revenues are generated from your largest clients. So the way, if you want to grow, is to get rid of your small clients and replace them with large clients. And so the focus is on those higher clients. And as many realize, beginning in January, I raised my minimum to $1 million, and we have 100,000 level for Craig Roth. We have 100,000 for Chris Yand when he's licensed, and 100,000 for Elizabeth when she's licensed. There's a reason for that. The reason is most of my clients, my average client account right now is running around 700,000 or 800,000. But a lot of those accounts began at 100,000, and some began even less than that. So what that means is we're growing our assets. We're moving our assets from the low end to the high end. That's a lot different than going out and trying to find a lot of new clients to come in. Oh yeah, we want new clients. And I want to see Craig and Chris and Elizabeth have the experience and the joy of growing accounts and seeing what they can do in terms of seeing client accounts grow, and not just planning for the future, hoping that it's going to be just like the past, but really growing accounts and giving people financial flexibility, financial freedom, giving them the ability to enjoy a lifestyle that's above what they were planning for, above what they've experienced. That's why their limits are set different than mine. I want them to focus on those accounts and the growth of those accounts. That's where they are. That's what we'll do, and that's what we will do for our clients. That's what this is all about. It's putting the client's interest first. The client is the most important part of our business, and that's what we do. That wraps up for today. I hope you enjoyed the program. I thank you for listening. And if you missed part of this program or any of the other programs, you'll find us on YouTube. You'll also find it podcast on our website. Do visit the website. Do look at the performance. Do look at the performance numbers. And join us again. Like us on Facebook. Like us on Twitter. And when it's Saturday, we will be back to talk about money. Have a great weekend.
You've been listening to About Money with Mike Adams, a registered investment advisor. If you'd like more information about what you heard today, or about Mike's investment philosophy and strategy, or if you'd like Mike to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared in the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Saturday at noon for more About Money with Mike Adams here on AM 1590. The Answer. The preceding program was sponsored by Adams Financial Concepts.